Hi, welcome to Solution in YouTube channel. In today's video we will discuss the basic accounting equation in detail. The accounting equation states that a company's total assets are equal to the sum of its liabilities and its shareholders' equity. This straightforward number on a company balance sheet is considered to be the foundation of the double-entry accounting system. The accounting equation ensures that the balance sheet remains balanced. That is, each entry made on the debit side has a corresponding entry, or coverage, on the credit side. The accounting equation is a representation of how these three important components are associated with each other. Assets represent the valuable resources controlled by the company, such as cash, inventories, buildings, etc. Both liabilities and shareholders' equity represent how the assets of a company are financed. If it's financed through debt, it'll show as a liability, but if it's financed through issuing equity shares to investors, it'll show in shareholders' equity. The accounting equation helps to assess whether the business transactions carried out by the company are being accurately reflected in its books and accounts. Let's see at some common examples of items listed on the balance sheet. Assets. Current assets include cash and cash equivalents or liquid assets, which may include treasury bills and certificates of deposit. Accounts receivables list the amounts of money owed to the company by its customers for the sale of its products. Inventory is also considered an asset that can include stock purchased for reselling purposes. Fixed assets like property, plant and equipment that are used for more than 1 year are also included on assets side. Liabilities. Liabilities are debts that a company owes and costs that it needs to pay in order to keep the company running. Debt is a liability, whether it is a long-term loan or a bill that is due to be paid. Costs include rent, taxes, utilities, salaries, wages, and dividends payable. Shareholders' equity. The shareholders' equity number is a company's total assets minus its total liabilities. It can be defined as the total number of dollars that a company would have left if it liquidated all of its assets and paid off all of its liabilities. This would then be distributed to the shareholders. Retained earnings are part of shareholders' equity. This number is the sum of total earnings that were not paid to shareholders as dividends. Think of retained earnings as savings, since it represents the total profits that have been saved and put aside, or retained, for future use. The accounting equation is a concise expression of the complex, expanded, and multi-item display of a balance sheet. If a business buys raw materials and pays in cash, it will result in an increase in the company's inventory, an asset, while reducing cash capital, another asset. Because there are two or more accounts affected by every transaction carried out by a company, the accounting system is referred to as double-entry accounting. The double-entry practice ensures that the accounting equation always remains balanced, meaning that the left side value of the equation will always match the right side value. In other words, the total amount of all assets will always equal the sum of liabilities and shareholders' equity. Let's take an example. Assume that Alex started his new car showroom with the following. He invested cash $1 million, had inventory of cars worth $600,000. For these assets he borrowed $1,200,000 from bank and brought $400,000 cash of his own. The accounting equation for Alex's showroom will be like this. On the assets side we will have cash $1 million, and inventory $600,000. On the liabilities and equity side we will have bank loan of $1,200,000, and $400,000 of equity, making the total of each side equaling $1,600,000. Assume Alex purchased 3 new cars from dealership against $300,000 cash payment. This will increase the inventory by $300,000 and decrease cash by $300,000. The equation remains balanced with total of each side equaling $1,600,000. After 1 month, Alex sold a car for $150,000 cash and repaid $100,000 of bank loan. Now these are two transactions. First, the car worth $100,000 was sold for $150,000, generating a profit of $50,000. This will increase cash by $150,000, decrease inventory with $100,000, making a net increase of $50,000 on the asset side. On the liabilities and equity side, this will increase the equity with the amount of $50,000 profit made up of $150,000 sales, less $100,000 cost of goods sold. Hence the equation is balanced with total $1,650,000. The second transaction was a loan repayment of $100,000. This reduced cash by $100,000 on assets side and reduced bank loan of $100,000 on the liabilities side. As a result, the equation is still balanced with total $1,550,000. Notice that after each transaction, the total of both sides was equal. Now you see that how accounting equation is for accurate financial reporting. If this video was helpful for you, please hit the like button and don't forget to subscribe for more videos. See you in our next video.